The Australian Financial Review.
What did you think when you saw it this morning?
Well, it's weird. I woke up and I was like, I saw the headlines of Trump has pivoted, this is great. And I looked at the market thing and I'm like, yeah, that's not up so much. That's a bit disappointing.
Last week, the AFR's markets guru, Jonathan Shapiro, was suffering from a chronic case of market whiplash and sleep deprivation.
Like, why is the Nasdaq only up 0.3%? And then I rubbed my eyes and I'm like, oh shit, there's a 1 in front of the 0. It's up 10.3%. Oh, wow.
It's been a wild ride on markets since Donald Trump imposed the highest tariffs in 100 years and started an all-out trade war with China. Markets have stopped panicking a little since Trump announced a 90-day pause for most countries. But the huge uncertainty is here to stay. And that's left traders, investors and reporters scrambling to catch up and work out who will come out on top in this new world order.
We're all losers in a world where there's less free trade, and particularly in Australia, we're a small trade-exposed economy that's been a huge beneficiary of globalisation. Welcome
to The Fin. I'm Fiona Buffini, in this week for Lisa Murray. Today, senior reporter Jonathan Shapiro and Chanticleer columnist James Thomson on what's going on in markets, how Australia is more exposed than ever, and why the Trump chaos is changing the world. It's Thursday, April 17. Hi, James. Hi, Johnny. Thanks for coming on the podcast.
Thanks for having me, Fiona.
Great to be back, Fiona.
So, Johnny, we're talking on April 14. It's been a really scary 10 days in markets, close to the turmoil of the pandemic or the global financial crisis. But unlike those crises, this shock was self-inflicted by Donald Trump. Before we look at how everything's changed, take us back to the start.
Well, Fiona, it really started on Liberation Day, which is April the 2nd, and there'd been a build-up to this day when Trump was going to announce all his tariff plans.
My fellow Americans, this is Liberation Day. Waiting for a long time.
He stood out on the Rose Garden and he pulled out this oversized cardboard prop.
For decades, our country has been looted, pillaged, raped, and plundered by nations near and far.
For the reciprocal tariff rates that would be imposed on all these countries that would pay their dues to the United States. Now, obviously, we know Trump is a big believer in tariffs and he promised to bring these in. But that day, I think, caught everyone off guard. Those numbers were a lot more shocking, those tariffs, way more punitive than everyone expected. So the market duly fell about 5%.
The shockwaves are still coming after Donald Trump's sweeping new tariffs on all imports into the United States.
China is striking back. In just the last hour, Beijing announced it is now slapping new retaliatory tariffs on all U.S. goods.
We were now in a full-blown trade war and markets were in a state of panic. As Sunday afternoons turned into Sunday evening and Monday morning approached, there was this real feeling of dread that I guess we haven't felt since COVID or the GFC. Everyone in Australian financial markets knowing that they're going to show up to work on Monday and the market is going to get hammered and just not really knowing how bad it would be.
The ASX crashing 6.3% on opening, wiping out $160 billion in 10 minutes.
It was a pretty ugly Monday morning. The commodity stocks got belted, oil stocks got hammered. This was a classic equity market panic. Investors were worried, stocks were being sold, buyers of bonds turned into sellers.
I think we should stop and talk about bonds today because something really funky happened in the bond market, which is so.
And by Thursday, the hand of Donald Trump had been forced. He announced a 90-day pause on reciprocal tariffs.
You know, they're getting a little bit yippy, a little bit afraid.
I think for me, the weird thing is that the market was so surprised by something that really wasn't very surprising. Trump had told us for months that the tariffs were coming, but I think investors and strategists were almost sure they knew better. They were sure that it was all a bluff by this master negotiator, Mr. Art of the Deal, and even up until Liberation Day, investors were sure the tariffs either wouldn't happen or wouldn't be that bad. And as Johnny said, that's when reality arrived. The tariffs were much worse than expected. They were all over the place and they seemed to be directed at blowing up decades of globalisation and free trade, which has generally been pretty good for the world and certainly good for America. I mean, it's only a few months ago that every investor and their dog came into this year talking about US exceptionalism and how that would be the dominant theme of the market this year.
And Johnny, Trump seemed to be holding the line when it was just the stock market falling, but when investors started to sell bonds, that's when he blinked. Can you explain to us why the bond market really changed Trump's mind?
Okay, well, why don't we take a step back and just understand what the bond market is and why it's so important. So basically, it's how governments around the world finance themselves. So they issue debt and it goes to investors around the world, such as banks, pension funds, the savings of other countries. And these bonds are issued at various terms, like 1 year, 3 years, 5 years, 10 years, 30 years even. And the rate or the yield on these bonds is essentially the cost of financing. So the higher the interest rate or the higher the yield, the larger the interest bill is for the government's budget. Now, the US is the richest and most powerful country in the world. So its bonds, which are known as US Treasuries, are really the benchmark for every other financial asset in the world. So, for instance, if the US 10-year bond rate is, say, 4 or 4.5%, you would expect the return of every other asset over the long run needs to be higher than that, because that is essentially risk-free. It's the safest investment you can make, and everything else is riskier and therefore should deliver a higher return for investors.
So what you're saying is what normally happens in a crisis is stock prices fall, but bond prices rise as money rushes into this safe haven asset. But that's not what happened last week.
Yes, globally investors were pulling their money out of US bonds and the US dollar, and it was a really unique moment in which money was rushing out of these safe haven investments at a time of panic. Now, this sort of phenomenon is pretty common in emerging market countries like Turkey or Argentina, Brazil or South Africa. Like, they're pretty used to these sort of crises, where money is just leaving their country in all forms. But it almost never happens to the US, and this is what unsettled a lot of investors. And it's a reminder that how powerful the bond market is. And if it's disrespected, rates go up. And when those rates go up, your financing costs go up too. And you get to a point where action has to be taken or plans have to change.
So both of you have met US Treasury Secretary Scott Bessent, and it's being reported that he was really influential in Trump hitting the pause button on the tariffs. What do we know about him?
Yeah, well, Scott Bessent's a former hedge fund manager. He likes to say at almost every available opportunity there's been in markets for 35 years, studied at the feet of great investors like George Soros and Jim Chanos. And over the last few years, he's sort of emerged as a stronger voice on macro markets. And then in the last few months, he's emerged as the Trump fan and, in the wake of the election, the Treasury Secretary. I think most investors thought this was a good thing, One of us is in the White House and has got the ear of the president. But he's sort of changed a little bit. He likes to describe himself as a glorified bond salesman. He's very focused on the bond market and getting the 10-year government bond rate down towards 3% from around 4.5% at present. He sees that as a much more sustainable level for the US given its huge debt. But when the market started to fall, he did this interview with Tucker Carlson, who's a conservative talk show host in the US, and described what he thought about where the markets were moving.
The market goes up and down. Warren Buffett has a saying, in the short...
But remarkably, he tried to say that the market moves that we saw last week had nothing to do with Trump's tariffs.
I can tell you that this market decline started with the Chinese AI announcement of DeepSeek.
And Bessent said it was more to do with the magnificent tech stocks getting a hammering.
What's happening with the market, I'd say it's more a Mag 7 problem and not a MAGA problem.
Right. It's a pretty extraordinary thing to say, given we're all sort of soaking in this tariff mess and he's pointing over there and saying, no, it's all about that thing. And there is some credence to the view that the sell down in tech stocks has been running for some time, but to suggest this was nothing to do with tariffs was just silly from Bessent, who was seen as this sort of wise old head in markets. He came out to Australia about 7 years ago for a conference, and certainly in those days he was less chummy with Trump. He even made a joke at the Sown Hearts and Minds event about Trump's tweeting saying, who knows where the economic data would be if the president had no thumbs and slept for 8 hours.
And Jonathan, you've actually interviewed Besant, haven't you?
Yes, I interviewed Besant in 2018 in New York in his office in Manhattan. And I guess I wish I knew, I wish I knew it was coming. I would have kept my notes. I would have kept my recording. I remember having an exchange with him about Elon Musk at the end of it. And if I could recall, he didn't quite say he would bet against Elon Musk, but I don't think he didn't come across as a huge fan. But my recollection of that interview, helped by the article I wrote afterwards, was when I sat at his table, he had a printout of a Wall Street Journal article and he just pushed it across the table to me. And it was all about being very hawkish on China. As James said, he's a man of the market. He's well known to Australian institutional investors. Those that know him say he's quite, socially liberal, but very economically conservative. And the other impression got from meeting him, and then when he was down here in Australia, he was very focused on the deficit. He really did see that as a big problem, that the US had too much debt. And this was a problem that had to be solved, for the good of the long-term good of the United States. I think everything he's done since he's taken the seat under Trump is consistent with that.
So, James, Trump reversed his decision. He listened to the market and the market seemed to have calmed down. What's the mood like among investors and traders now?
Well, I think the mood is still highly uncertain. I guess on one view, it does appear that Trump has a pain threshold in the market, and it's probably somewhere like a 10% loss on the S&P 500, which is the benchmark index in the US. And it's the US 10-year government bond yield at about 4.5%, as Johnny said. That's where it seems like Trump's pain point is. But no one can be really sure of that. And no one can be really sure of what the next move in these tariff wars is. Yes, we've got a pause on tariffs and a baseline tariff of 10% now set on most countries, with the exception of China, which still has very high tariffs. But everything's moving so quickly.
Tariffs on China started yesterday. Those taxes now total 145%.
Over the weekend in China, we had Trump seem to exclude some products like smartphones and computer chips from those Chinese tariffs.
As the U.S.-China trade war heats up, the Trump administration is exempting smartphones, laptops, and other electronics from his reciprocal tariffs.
Mm-hmm.
But then he backflipped on the backflip and said that the exclusions are temporary and, there'll be more to come on that. So markets are still trying to puzzle this through. It's just a sea of uncertainty, and markets hate uncertainty. We've also seen China jump in and ban the exports of some rare earths into the US manufacturing sector, which just shows that whatever, relief we get, the trade war is still ticking along. And then, of course, we've been told by the US administration that there are 70-odd countries that want to do deals with America over the next 90 days. But how realistic is it that those deals can actually be done? And then what do the deals look like? Again, it's more uncertainty. And all the while all this uncertainty is going on, the world seems to be getting more and more sour on US assets. The US dollar keeps falling, bond yields are holding firm, and people keep turning away from American assets.
Mm-hmm.
And Fiona, I think the most important thing here is that the world as we knew it before April 2 is gone. Everything we knew about financial markets has been ripped up, and we're in a new world where uncertainty reigns.
Okay, Johnny, we've been talking about an extraordinary couple of weeks on the markets, and the situation is still volatile. We've got universal 10% tariffs still in place. A US recession remains a concern. America is still in a big trade war with China, and Trump could do all of this again in 90 days. We're left in this new era of uncertainty, and markets hate uncertainty, right?
Yes. The one conclusion that we can make with confidence, just based on where prices are now, is the cost of everything is going up. I mean, tariffs mean the cost of everything goes up.
Mm-hmm.
But what we're seeing is also sort of the cost of capital go up. So that US bond rate, that's the risk-free rate that sets returns and rates across all assets on Earth. It all sort of rests on what the safest country in the world is able to borrow money at. And that rate is all over the place at the moment. It was 4%, it's creeping up to 4.5%. We've seen a knock-on effect in corporate debt markets. So the credit markets, they were very calm for a long time. They are now starting to crack, and we're seeing corporate debt spreads go up. So that is a worry. Typically, high cost of capital, high interest rates, especially in a world where there's potentially lower growth, means that it's not going to be a pleasant environment, potentially. So we need to prepare and accept for a new world order where capital is more expensive and more difficult to get.
Yeah, I think the other thing, Johnny, it's hard to know where investors should go at the moment. As John Pearce, who's the Chief Investment Officer at one of the big super funds, UniSuper, told me about 10 days ago, if you wanted to sell, you're too late. You've sort of got to take your punishment and now look for some opportunities. But the question is, when's the right time to buy? Do markets have further to fall? Do you have to wait until there's some sort of certainty or for a clearer sign that Trump is moving away from these tariffs? That's the problem, I think, that a lot of investors face. It's hard to know when to jump in and take advantage of this crisis. You know, the best investments are often made during periods of deep discomfort, and this is a period of deep discomfort. But it's hard. When a market's going to hit the bottom, that's the question that's really difficult to answer at the moment.
Yeah, and just to add to what James says, there seems to be a general opinion that, yes, the equity market is a lot cheaper than it would have been a few weeks ago, but it might not be cheap enough because, you know, if we are entering a recession or something worse, that means earnings are going to fall quite sharply. And on that basis, you could argue that the equity market still has quite optimistic forecasts. And if optimism turns into realism and even into pessimism, I guess you could still rationally see sharp falls in equity indices.
Yeah, exactly.
And one thing different this time around is Australian investors are particularly exposed to what's happening in the US because of the $4 trillion we've got in super. Can you talk about that?
Yeah, absolutely. I mean, Australian superannuation investors are probably overexposed to the US at exactly the wrong time. I mean, according to Deutsche Bank, super funds entered 2025 with just over 30% of their capital in international equities, and about 3/4 of that would have been in the US.
Wow.
Now, that exposure's worked really well for them in the past 3 years because US equities have risen more than 70% on this idea of US exceptionalism. You know, tech stocks going well and US government spending powering along, the US economy growing nicely. And that's helped household wealth in Australia grow at about 8% a year. The total pie of household wealth is now $17 trillion in Australia, or about $616,000 per person, which is amongst the highest in the world. But the problem we've got is that Australians are asset rich through their superannuation balances and their houses, but they're pretty cash poor. And that's why you can see this drag on the Australian economy.
I mean, I guess there was the COVID crisis of 2020, but the last major crisis before that was in 2008 during the global financial crisis. And back then, the superannuation system was about $1 trillion of assets. It's now tripled to about $3 trillion, and that's the professionally managed. I think if you include self-managed super, that's another $1 trillion. And as the superannuation system has grown, it's almost been left with little choice but having to invest more of it into global equity markets. And that typically means US markets. So super funds have to be large and they have to be liquid. They have to be ready to meet, you know, if you want to take your super out on any day, it needs to be invested in assets that they can sell quite easily. And that means global equities. So and global equities means US stocks. So the amount of money that Australian super funds have invested in US stocks as a percentage of a typical super fund has more than doubled. I'd say from about 15% back in 2008 to about 30 to 35%. And as James said, that has left Australians very exposed to movements in the US stock market. And that's why the last 3 or 4 months would have really hurt. I mean, if you'd been in the workforce for about 20 years and you looked at your super balance last week, you probably had about a good $20,000 wiped off in just a week. So that will hurt.
Yeah. And what do you think about what this means for interest rate cuts? The RBA governor last week said the market turmoil is not as bad as the GFC, but do you think we'll be getting more rate cuts now?
I think it's on the table. The Reserve Bank in Australia has been so focused on domestic conditions. Where's inflation going in Australia? But this is a sort of curveball that they wouldn't have thought they would have been dealing with a couple of months ago. So I think that the potential for the RBA to sort of support the Australian economy with a rate cut or two is there. But their problem is that inflation's still outside their target band and they're still fighting to keep inflation low. So their hands are tied a little bit, but I think if we see real signs of emergency or panic or even a whiff of recession, that will give Reserve Bank Governor Michelle Bullock the scope to do something if required.
Yeah, and just to add about trying to interpret what the bond market is trying to tell us, and the bond market is pounding the table, but the bond market is saying that, yes, the RBA will be cutting rates quite aggressively over the next 6 to 12 months, possibly about 1.5% of rate reductions by the end of the year. But the irony is, with the bond market's looking out further to like 7, 8, 9, 10 years, they're saying that, those cuts will be reversed and the RBA will probably have to hold rates higher for a long time. So you're almost getting these mixed messages of very short term. And it's quite similar to what the bond market is saying will happen in the US, is that central banks will have to come to the rescue of economies by reducing rates. But over the long term, interest rates are probably going to be high and stay high.
Okay, a final question for both of you. Are there any winners and losers from all of this chaos?
If there were winners, maybe it's people like myself that have this belief in free markets. So, at the depths of the drama, it was the bond market that forced Donald Trump's hand. And maybe it's a sign that, the bond market will exert its power and influence on policymakers when they feel like they're going in the wrong direction. So that's the hope I'm clinging on to, is that free markets were the winners.
The losers are all of us. We're all losers in a world where there's less free trade, and particularly in Australia, we're a small trade-exposed economy that's been a huge beneficiary of globalisation. So this is not good for us. Australians and Australian investors, and really the world's investors, have had a pretty good ride for a long period. We haven't had recessions other than COVID. We've had low interest rates. It's been relatively easy to make money, and our super fund returns have reflected that. It's just not an easy world now. Trump loves chaos. It's not a bug, it's a feature with him. And so that's what we need to get used to.
Thanks, James. Thanks, Johnny.
Thanks, Fiona.
Great to be here.
Thank you for listening to The Fin. I'm Fiona Buffini with senior reporter Jonathan Shapiro and Chanticleer columnist James Thomson reporting today. The Fin is produced by Alex Gow, Lap Fan is head of podcast, and our theme is by Alex Gow. If you like the show and want to hear more, follow us wherever you get your podcasts and consider rating and reviewing us as it helps others find us. With the federal election campaign in full swing, The Fin is releasing a special weekly podcast every Tuesday. Political editor Phil Curry and our other Canberra experts join The Fin to break down the big issues. If you want to send us a question for the political panel, email thefin@afr.com. For more stories about markets, business and power, subscribe to The Financial Review at afr.com/subscribe. Lisa Murray will be back next week. Thanks for having me.
The Australian Financial Review.